Hello, and thank you for tuning in to another episode of CPA Review and More. We are pleased to bring you the #1 podcast for CPAs and CPA candidates. If you'd like to learn more about how Yaeger CPA Review can help you, find us on our website at YaegerCPAReview.com. Now, here's your host, Phil Yaeger.
Hello, everyone. This is Phil Yaeger, and welcome to our podcast on this beautiful day. And I'm here with Ron Premuroso, my partner in crime. Now, Ron, in my last podcast webinar, I came out and said that I was really annoyed. There were a couple of the courses, our competitors, who were announcing that buy my course right now, because come January of 2020, they're having major changes. Now, Ron, you know that's not true. Isn't that correct?
Yes, Phil. And we, as you know, Phil, you have very close connections with the ICPA. They have announced to you and all the other providers, in fact, that there are no changes to the blueprints, number one, for Q1 and Q2 of 2020. Okay, so that's number one. That's very important. Number two, as we know very well, Phil, especially under FAR, the FASB is always issuing updates, right, and changes to accounting principles or clarifications, et cetera, et cetera. And there have been some updates made in certain topical areas, and we'll cover those a little bit in a moment. But really, Phil, except for maybe the credit loss one, and that also changed as of Friday with an update we got from the ICPA.
Can we do this? Let's talk about the changes they said we're going to be on.
Yes.
And let's talk about this FASB delays 4 of the major standards.
Yes.
Okay.
So, yes. And Phil, we also have to point out, we've posted on our website, right, an updated piece of paper, a sheet, which summarizes all these changes. So if you go to our website, right, YaegerCPAReview.com, you will find a little nice summary sheet that we have prepared for any candidates taking the exam.
And it's under the resource tab. If you go to resources on our own page, all right, it says changes for January 2020. Now let's go back before we got this article, all right, from the Journal of Accountancy about what is not going to be going into effect. Well, first of all, the changes that were going into effect were minimal. So any course that told you that there's major changes, that is not true. There were some changes or additions to financial accounting. Now, one of them was a measurement of credit losses on financial instruments, all right? The second one was basically a new method of how you actually record the impairment on Goodwill. That was the second one, all right? And then they had another disclosure, a fair value measurement disclosure requirements for fair value measurement, all right? Just reading what it says here, all right? And number 4, but not-for-profits, all right? They updated the definition of what collections are. Now, that is not any different. So if you go to our site, you'll see that on there. Now, we're going to actually have to go to the site and change that, all right? Because some of those things are not going into effect. But number 4, which is ASU 2019-03, not-for-profit entities, topic 958, all right? It talks about the definition of collections, all right? And also, the next one, which also deals with not-for-profits, am I correct? It's GASB Statement 87 on leases, all right, which basically says that the lease rules for not-for-profits will be the same as the lease rules for profit-making organizations. The journal entries will be the same. And one other one, there was another GASB change, which says that if a nonprofit entity is doing any type of pre-construction, all right, it used to be where the interest on the loan to do the construction was capitalized to the asset itself. Now the interest is determined to be expensed. All right, that was a change. Now, Ron, February 15th, November 15th, I'm pushing the year ahead. November 15th, I saw in the Journal of Accountancy, and they also sent this to me because I am a course provider. They sent me some modifications to those updates. Now, Ron, you want to talk about those?
Yeah, briefly, Phil, I think what we read in there is some of what you just described, or most of what you've just described, is postponed for non-public entities until 2020 or 2021, I believe. Okay.
Yeah.
So, yes.
The one on credit losses.
Yes.
Derivatives and hedging and leases. All right. There's a delay in the effective date, as Ron just said, for private companies. Okay.
Yes. Yep.
All right. Not for profits. So it also covers not for profits.
Yep.
And also certain smaller reporting companies.
Yes.
But, all right, for SEC filers, all right, this does go into effect, this credit loss pronouncement, correct?
Correct. Yes, as of the end of this year, and therefore is subject, maybe, Phil, to a multiple choice question or something like that, okay, in early 2020. But again, this is not a major change, Phil, okay? It's actually a significant clarification of the rules for recording credit losses by banks and other types of entities.
And then in this Journal of Accountancy article, it says the new effective date for preparers that are not publicly held companies is, and this is for lease accounting, is for fiscal years beginning after December 15, 2020, gets a 1-year extension, okay?
Yes.
All right, which means the standard went into effect for fiscal years beginning after December 15th, 2018 for publicly held companies, all right? Now, what about the non-publicly held companies, the lease accounting, all right? The way I read this, it will go into effect when, Ron?
2020. I believe it's 2020, Phil.
Yeah,
right?
December for fiscal years beginning December 15th, 2020, all right?
Beginning December 2020.
Yeah, beginning after December 15th, 2020.
Yes. Yeah.
Now, does that mean that they're not going to ask questions on leases? What do you think?
You know, they're still going to, I think on this very narrow subject, Phil, the biggest thing it could be is maybe a multiple choice question, maybe even a test multiple choice question, okay, to see if candidates are keeping up with it. But I don't see this as a major modification, to be honest, Phil.
Yeah, I mean, when they brought out this lease pronouncement, all right, it did not true that practitioners had a lot of trouble implementing it.
And Phil, to this day, there are articles almost monthly on large companies and small companies having trouble implementing the new lease accounting rules, right? With the differentiation between operating and capital leases. It's still an issue today, okay, Phil? And, I think from that perspective, of course, bigger companies can handle it. Little companies, it's really a burden for them to implement the lease standard.
But the delay applies to publicly held and non-publicly held companies, all right? Right?
Yes.
One has a delay of 1 year. The other one goes to December 15th, 2022.
Yes.
All right? So I agree with you. I mean, why would they even give a multiple choice on this?
Yeah, I think they're going to test still, Phil, what's in our current materials, which is the differentiation between operating and capital leases, right? And financing.
Capital leases are gone, right?
Yes, but financing, of course.
Yeah, difference between operating and finance leases, yeah.
Yes, and the basic criteria there and what are the journal entries, okay, required behind that. That'll be it. And that's demonstrated in our current materials.
Yeah, and I think it would be the journal entries for the leases, the capital leases for the lessee and the lessor.
Yes,
okay?
Correct.
Right. Did I say
I want to mention too, Phil.
Did I say capital? Did I say capital?
Yeah, you said capital too. That's okay.
Fine. All right. Remember, if the lease is a finance lease for the lessee, it's a sales type lease for the lessor.
Correct.
Know those journal entries still.
Yes, and that can be tested. I also want to point out too, Phil, you mentioned about Goodwill. We also have that in our current materials. And we warned candidates that the testing for Goodwill, right, under the revised criteria is now starting, okay? So that's not really a new update, okay? And we had that in our materials in 2019, and we told candidates that the testing of that is starting right now, okay?
Was there any changes on the way you calculate impairment of Goodwill, all right? In other words, was there a method before and a method now?
Well, there was a 3-step process, okay? Right now, it's basically a 2-step process, okay? They made it much simpler, okay? Where, in summary, you compare the carrying value on the books, right? Which is the goodwill you recorded initially when one company buys another company, less any write-down they may have made to date, to the fair market value of what that goodwill was generated by will generate in the future, okay, using cash flow techniques. It's really very simple today, Phil.
So now you're comparing, you take the carrying value of your goodwill.
Yep.
And if the fair value of the cash flows, is that correct?
Yes, fair value of cash flows.
Is less than the carrying value, you record an impairment loss for the goodwill, right?
Exactly. And you write it down. And of course, under US GAAP, once you write it down, you leave it down, okay? You cannot write it back up again. And
Correct.
under IFRS, you can write it back up and back down again as time progresses. And they also simplified it, Phil, where really it needs to be done on an annual basis only rather than a quarterly basis, because they figure that it's much easier on an annual basis to assess changes in that fair market value than it is.
But what happens if they're preparing interim financial statements?
Well, I mean, the only thing you'd look for there is an obvious huge impairment, right, in that goodwill. So say a new competitor came into the market and obsoleted, right, the products of a company that you bought, recorded all that goodwill for. Of course, you can't ignore that on an interim basis. But it's not as strict, I believe, as it once was on an interim basis compared to an annual basis.
Now, on the handout on our website, the first page talks about ASU 2016-13 financial instrument credit losses, and it talks about the measurement. Now, once again, I think we mentioned this before, but that pronouncement has been postponed. Isn't that correct?
Correct, yes.
All right. So it says here, the effective date for SEC filers, which is publicly held companies, excluding smaller reporting companies, whatever that is defined by the SEC, remains as fiscal years beginning after December 15, 2019. So the pronouncement is in effect for basically smaller reporting companies, right?
Correct.
And also for SEC filers.
Yes.
But the new effective date for all other entities, like privately held companies, begins after December 15, 2022. And this change will extend the effective date for smaller reporting companies by 2 years, and for private companies that are the non-SEC filers. Okay?
Yep.
With that, the fact is they change it, even though it's for private companies, they extended it 2 years. Yes. I don't know. Do you think they would ask a multiple choice on that?
Phil, I think that's a worst case, right? And it's just one question, okay, out of so many questions, so not significant. I think the point we're trying to make, Phil, and you're trying to make is, all the alarms being raised by some of the competitors regarding materials being out of date, and you need to subscribe to the new materials now because starting in January, you're going to get bombarded with all of these changes that we just went through on FAR is really not an accurate statement, Phil.
And it says in the article that the FASB began considering the delays in response to concerns from preparers struggling to cope with the major changes to the standards. All right. So the preparers, the CPA firms, they're having trouble coping with the changes to the standards.
Yes.
And it says that the concerns of the preparers, led by the AICPA's Technical Issues Committee, all right, sent a letter to the FASB requesting a delay. Okay. The preparers asked for a delay. All right. Okay. This is a mess. That's what it really is. Yeah, so, I wouldn't get all bent out of shape. Also, if I may mention this, a little plug for our course, our new 2020 course is entirely done. That means the books are entirely done. The videos, everything is done. We are entirely done. Now, what we're doing, because we're just a wonderful company, and you can tell by looking at the two of us, the most honest guys you'll ever see. Are we not, Ron?
Yes, absolutely, Phil.
Yeah, we're also damn good-looking accountants. All right, now, we are offering a discount off the price on the website. All right, this is another discount you can take, and what it is this. If you order the new 2020 course, all right, you will get an additional $100 discount, all right, on all 4 parts. Okay? Now, there is a discount code that you must put in when you order it. For all 4 parts, it would be Web4. Web4. Now, if you have any questions on this, you can always call Sonny in our office at 301-874-4900, and Sonny will help you, all right, if there's any questions. And that's, by the way, that's 301-874-4900, extension 6, all right? Now, let me look at a few things that came up here. Ron, I got a question this morning that said, this has to do with foreign currency.
Yes.
What keywords do you look for in multiple choice questions to determine if it's a foreign currency translation or foreign currency remeasurement? And the person said, I thought translation or remeasurement would be the keywords, but not in all cases. Thanks. Now, can you explain what the difference is between translation and remeasurement?
So remeasurement, Phil, normally implies that you are taking, for example, if you have a subsidiary in France, right, that's reporting in euros, and that company's results are being reported by a U.S. parent company, which owns it, you would then remeasure, right, those euros and translate them, right, into U.S. dollars following the FASB rules, okay? And as we all know, right, you translate the balance sheet at the current rate, right, the balance sheet, the date of the balance sheet exchange rate, and you translate the income statement accounts at the average rate, right, during the period. So
okay, can you repeat that one more time? That was very good. Good point.
Yeah, so if your company is an American company with a French wholly owned subsidiary, right, which is, of course, preparing their books in euros, right? All the countries in Europe today basically prepare their books in euros, right, which is a requirement in their country. When those euros are remeasured, right, and translated into U.S. dollars, right, you translate the balance sheet accounts at the balance sheet date at the end of the period's exchange rate, and you translate the income statement accounts at the average exchange rate that prevailed during the period. So don't be fooled by these words of remeasurement and translation. They're very much linked together, Phil. Remeasuring, right, the euro-based financial statements.
Well, let's go back here a second. How do you know if a question is asking for translation? And by the way, what is a remeasurement? Let's just talk about that
into another currency, Phil, basically, okay?
So are they the same?
It's basically the same thing, Phil, okay? When you remeasure a foreign subsidiary's results, you translate them into the reporting currency, okay? So in my example, you're translating the French subsidiary's euro-based currency, right, into U.S. dollars so that the parent company can consolidate, right, that French subsidiary's results into their consolidated results.
And you use the same thing you did as far as, how do you remeasure it? You were saying that one is what? The current
balance
rate?
sheet. The balance sheet is the current rate, right? The balance sheet date rate, exchange rate between euros and the dollar. And for the income statement accounts, it's the average rate that prevailed during the period that you're reporting upon. I guess for a multiple choice question, Phil, my experience is that they're either going to say, generally they're going to say translation, okay? Remeasurement basically means the same thing. Now, if they're asking you to research the codification, right, then you would use those keywords, right? Foreign currency translation or remeasurement, right? Foreign currency remeasurement. If they're asking you for authoritative guidance on how you would translate a foreign subsidiary's based financial statements into a reporting currency. Okay, so, I wouldn't be so concerned about that. I think remeasurement, Phil, is really an old term, to be honest, compared to today. It's really foreign currency translation and foreign currency transactions. That's where the exam focuses today, in my opinion.
And you will have foreign currency gains and losses, right?
Yes, realized or unrealized, right? Realized if there's transactions going on, okay? Unrealized if there's translation, right, Phil? When you're translating the foreign subsidiary's financial statements into U.S. dollars, and that's a component of stockholders' equity, okay? Translation.
Other comprehensive income?
Other comprehensive income, and then into stockholders' equity as a contra account.
Okay, so foreign currency gains and losses are, first of all, they go into the stockholders' equity as
Yes.
other comprehensive income, right?
Yes.
Net
Yes.
of tax. Net of tax.
Yes, correct.
All right. Don't put that in the income statement. Am I correct?
Only realized foreign currency transaction gains and losses
Now,
go
what do
into
you have
the
a
income statement.
realized versus an unrealized?
Well, for example, you're doing foreign currency hedging, okay? Say, again, a U.S.-based parent is selling its products to its French subsidiary, right, in U.S. dollars. And so the French subsidiary has to come up with euros, right, in a sufficient amount to repay the U.S. parent. In those cases, you would have realized and unrealized foreign currency transaction gains and losses, and those always go into the income statement. Let me also mention, too, Phil, when a U.S. parent liquidates a foreign subsidiary, the accumulated foreign currency translation gains or losses then go from other comprehensive income to the income statement, okay? It gets reclassified from one statement to the other. So it is very important, Phil, on foreign currency to know what goes through the income statement, as you mentioned, and what goes through OCI.
Could you see a test-based simulation at foreign currency?
Absolutely, yeah, because they can test whether you understand to translate the balance sheet, right, at the end of the period exchange rate, whether or not you understand how to translate the income statement, right, at the average prevailing exchange rate. They could also test whether you understand that when you translate the balance sheet and income statement of a foreign subsidiary, there's a plug. That's a nasty word, right, in accounting, Phil, but there is a plug when you translate a foreign subsidiary's balance sheet and income statement into U.S. dollars, and that plug is called foreign currency translation, right? Accumulated for unrealized foreign currency translation gains or losses, which, as you mentioned, goes through the OCI statement.
And you said the realized, that's where if you have to buy something from a foreign country,
yes,
and you actually have to convert U.S. dollars to euros,
yes,
and there's a loss on converting that, that's an actual foreign currency realized loss, right?
Correct. And it's reported in the other income portion of the income statement, okay, Phil? Below operating income, okay, on your multiple step income statement.
Very good. That's a good explanation. I mean, really it is. Now, let me see here. Let me talk about some of the areas. Now, last time when we were doing this, and we didn't get to it, long-term debt. Now, I believe they're talking about where a corporation issues bonds. And if you issue bonds, you can issue them, they can either be at a discount or a premium. Now, the question is, when do you issue it at a discount or a premium? Well, your rate that you pay on the bonds is called the stated rate, okay? Let's assume the stated rate is 6%, all right? But all other bonds are paying in the market 9%, and that's the market rate, the 9%. Now, if you're only paying 6, all right, and everyone else is paying 9, you have to do something to make it a little attractive for them to buy your bonds. So therefore, think about it. I'm only paying 6. The market, all other similar bonds are paying 9. I'm going to have to sell those bonds at a discount.
Yes.
Okay? All right. Now, selling it at a discount effectively brings your yield up to the market rate. That's what it does. Now, if you're paying 9%, and by the way, if anybody knows any bonds at 9%, let me know, and the market is only 4%, all right, you're paying more than everyone else is. So therefore, you can be a big shot and sell it at a what?
Premium.
Now, remember this, all right? When you're preparing this, you have to do a bond amortization schedule because you have to use the effective interest method. Now, make sure you know how to actually amortize bond discount and premium. Now, basically, it's an amortization table, all right? Now, see if you can follow this. Please listen. The first column, to me, could be interest paid. That's the first column. The second column is interest expense. The third column is amortization of discount or premium. And the fourth column is your carrying value. Now, your carrying value is basically the price you're going to sell the bonds at. All right. Now, the question is this: how do you get the interest payment amount each year, each 6-month period? All right. The interest paid is the stated rate times the face value of the bonds. All right. Hey, the people who bought your bonds, they don't care whether it's a discount or premium. All right. They just want their interest at the face amount of the bonds. So therefore, you're going to take the stated or coupon rate, whatever it's called, times the face amount of the bonds to get the interest paid. Now, the interest expense is basically where you take the carrying value of the bonds and multiply it by the market rate or yield rate. Now, if you're paying bonds semi-annually, don't forget to take the yield rate or market rate. For example, if it's every 6 months and the yield and market rate are stated annually, let's assume it's 8%, then you're going to use 4% to multiply that by the carrying value to get the interest expense. Now, the difference between the interest paid and the interest expense is the amortization of the discount and premium. Now, if the bonds were originally issued at a discount, then the amortization of the discount is going to add to the carrying value. So when the bonds mature, it's going to come back to face value of the bonds, right? And if you sold the bonds at a premium, right, when you amortize the premium, it's going to reduce the carrying value, okay? Now, basically, remember this. Discount on bonds, unamortized discount, and premium on bonds are now, they're contra accounts to the bonds payable. They're contra accounts. Now, also, you can have issue costs. When you issue bonds, you have issue costs. Now, this changed, actually, because now issue costs are a contra account to bonds payable. They're no longer a separate expense item, all right? Then it used to be other assets. Now the issue costs, whatever they may be, all right? And by the way, do you amortize issue costs, Ron?
You know, Phil, I'm not sure, Phil. Do you? Of course you should, right?
You do. Yeah, you amortize it over the life of the bond.
Of life of the bonds, yes.
Right, on a straight line basis.
Yes.
Not an effective interest basis.
Correct.
Right? But whatever unamortized issue costs you have, don't put them as other assets.
Okay, I see.
Now they are contra accounts to bonds payable.
So you net it against the carrying value of the bonds, right?
That is correct. That's correct.
Got it.
The unamortized issue costs is a reduction to bonds payable.
Yeah.
Okay?
Hey, Phil, on the exam, a lot of times they will ask you on bonds, what is the interest expense for this period of time for these bonds? And you said a very important statement. It's the carrying value of the bonds times the effective interest rate on those bonds. It's very simple, actually, okay? And don't forget annual yields, right, as you described, Phil. But I just want to emphasize, I have seen practice multiple choice questions which have a lot of information in them, and all they're asking for is tell me what the interest expense was for this period of time on those bonds. And it's very simple. The carrying value of the bonds you are given times the effective yield on those bonds, Phil.
Yeah, I mean, another thing that people have trouble with, and that's accounting for income taxes, deferred taxes, all right? You have to know, if they give you multiple choice, you have to say to yourself, well, if they're asking for the current income tax expense, all right, does that have anything to do with timing differences? And the answer is no.
Exactly.
Right? To get the income tax expense current, you just take your current rate, all right, times the taxable income of the company, and that gives you your debit to current income tax expense and a credit to income taxes payable. All right. Now, when you're dealing with timing differences, all right, then you got to determine, is the timing difference create a situation where the taxable income in the future is going to be higher or the taxable income is going to be lower?
Yep.
And if you have a timing difference, and let me give you an example. Warranty expense is probably the one that comes to mind.
Yep.
All right. You must accrue warranty expense according to GAAP as long as you have some type of past experience on when you sell an item, how much of that item will result in future warranty expenses. All right. And then on your books, you'll debit warranty expense, if you can determine this, and credit an estimated liability. But on the tax return, you cannot deduct warranty expenses until you actually have a warranty expense item, which means they're incurred. You have to pay for them. Now, if you have to set up a warranty expense and a credit to estimated liability, that is a book expense. Now, you're going to assume that that will reverse itself in the future, which means it'll be deductible on the tax return in the future, and you already deducted it on the books. So this is the way I tell you, all right? If you have warranty expense on the books today and there's nothing on the tax return, all right, what happens? In the current year, the book income is going to be less than the taxable income, right? Or the taxable income will be higher than the book income because you have an expense on the books, correct?
Correct.
But when that reverses itself, then it'll be a deduction on the tax return, which means your taxable income will be lower than your book income.
Yeah.
Now, when you have a timing difference today that causes taxable income in the future to be lower, be lower than book income in the future. If you have a timing difference that reverses itself and causes in the future, all right, taxable income to be lower than book income, that's called a future deductible amount. And you take that future deductible amount, multiply it by either the current rate or if you know the rates that's going to be in effect when it reverses itself, all right, and you come up with an amount, future deductible amount times future rate or current rate, whichever is known, will give you a deferred tax asset.
So the rate would be 21% today, right, Phil? Is the current income tax rate
Correct.
for corporations?
Correct.
Yep.
So what you would do is in the current year, not in the future year, in the current year, you would debit deferred tax asset and credit income tax expense deferred. Now, if you have the reverse, which is like depreciation expense, you can use accelerated depreciation on your tax return, all right, and then you can use straight line on the books. Now, eventually, what's going to happen? If accelerated depreciation is used on the tax return, straight line on the books, in the current year, taxable income will be lower than book income. But eventually, that reverses itself because eventually the straight line depreciation will be greater than the accelerated. That's the way it works. So let's go over this. If accelerated is higher in the current year than book, your taxable income is lower than the book income in the current year. Now, after the current year, you assume that's going to reverse itself, which means taxable income in the future will be higher than book income. All right. Now, that amount is called the future taxable amount. Future taxable amount times future rate or current rate, whichever is known, will give you what we call a credit to a deferred tax liability. And the entry will be credit, deferred tax liability, and you debit income tax expense deferred. Okay? So actually, your income tax expense on your income statement, all right, total income tax expense is made up of current income tax expense and deferred income tax expense. All right? And remember, each year, you're going to have to adjust the deferred tax asset and deferred tax liability because it's a balance sheet account. You have to basically do that. You're using what we call a balance sheet approach. That's what it is. It's an asset and liability approach. Anytime you have to adjust an asset and liability, it's an asset and liability approach, and you adjust that asset, all right, either up or down, adjust the liability either up or down, and the plug to the entry is income, tax expense deferred. Okay? That's the deal. Any comment on that, Ron?
Nope, perfectly done. And, Phil, it is very important to understand the basics on income tax expense, income tax payable, and deferred taxes, as you just said. I mean, that's a very common question, which appears, of course, in the blueprints, right, for FAR, that you must understand these basics related to income tax accounting, expense, and payables.
Now, you mentioned the blueprints.
Oh, yes.
Ron has mentioned these blueprints, all right, probably an unbelievable number of times. I can't even keep track of how many times we've mentioned this.
And Phil, here's the big question we get all the time.
Yeah.
Phil, what topics are heavily tested on the FAR portion of the exam, Phil?
And the answer is it's the blueprints they can test on, all right? Now, Can I tell you which blueprints they're going to test on your exam? No. All right. But they can test any of the blueprints. So the good thing is, you know what they can test, the blueprints, but you don't know which ones they will test on any specific exam. All right.
And Phil, our materials are perfectly aligned, right, to the blueprint.
Yes,
okay?
they are. In fact, I spoke to this woman yesterday from Chicago, and she said, I noticed that she printed out the blueprints from the CPA.org website, and she says, you follow them exactly. And the answer is yes. That's because they're incorporated in all of our books. Okay?
Yes. Yep.
So there shouldn't be any surprises.
No. And Phil, you know, you had a very good webinar recently with Mike Decker from the ICPA division. He was explaining to you that they have a pool of 4,000 questions, okay? And of course, you never know, right, which one of those questions and therefore related to the blueprints is going to appear on the exam. But Phil, another question we get very common, especially for FAR, Phil, I'll give you two questions, Phil. Which part to take first, in your opinion, would be the best strategy? And number two, once you answer that, because I already know the answer, right? We've discussed this many times, is what is the best way to study, in your opinion, for that part? What is a successful strategy for studying for that part and passing that part of the exam?
The best way of doing this is to start with financial accounting. This is the basis of all GAAP, all generally accepted accounting principles, all the FASBs. Now, then I would take auditing, because you're auditing the financial statements, and to determine, remember, the opinion on the audit is that the statements are what, Ron?
Presented in accordance with generally accepted accounting principles.
So when you're doing auditing, all right, they're going to ask you questions about certain accounts, and you have to know how they're presented in conformity with generally accepted accounting principles, which you only get by taking financial accounting first.
Yes.
All right. Now, I say the third part is reg, and then the fourth part is the BEC, because the BEC has written communications. And that's where you're going to write what? Memos?
Yes. Memos, response to a client, research type topics, okay, opinionated type topics related to that. So, and, I just want to come back again to FAR, Phil. If you're a candidate that hasn't taken the exam, hasn't been in school for a few years, right, and you feel you might be a little bit out of date, okay, on FAR, especially the theoretical material, Phil, because as we know, there's been a lot of changes to lease accounting and revenue recognition accounting, right, with those converged standards issued by the FASB and the IASB the last couple of years. And what would you suggest, Phil, to those candidates who maybe been out of school for a little while and need to get more up to date because maybe their jobs today are in tax or not areas really related to financial accounting?
Right. Yeah, and another thing, by the way, let me go back here to the written communications, which is on BEC.
Yes.
They can be either from financial accounting, auditing, or reg.
Yes.
Right? That's why it's good to leave that to the end. Now, I do tell people, in fact, when I talk to someone, they'll say, which part do you take first? I'll say to them, what do you do for a living? If they tell me they're in the tax department of a public accounting firm, I'll say, take the reg first.
Yes.
Taking the reg first doesn't affect any of the other things.
Yep.
All right? So you could take the reg first and then go to FAR, auditing, and BEC. Nothing wrong with that.
And the main reason, right, Phil, is you have a better chance of passing that. You get nice momentum, right? Positive momentum of passing a part, and you can move on to the other parts. Correct, Phil?
Correct. And the regulation, all of the blueprints are updated for the Tax Cuts and Jobs Act, the Trump Tax Act. All right? Now, remember, on regulation, they never test, all right, tax rates, and they don't test phase-out amounts because they change each year, all right? And also, you don't have to know the due dates of the returns anymore. Due dates are not given, all right? So you don't have to know due dates, you don't have to know tax rates, and you don't have to know phase-outs. People are memorizing phase-outs. That's ridiculous, all right? So when studying for tax, just follow the blueprints. They tell you exactly what you're going to have. Now, today, I spoke to someone about half hour before we did this thing, and he's taking the exam next Saturday. And he said, well, what should I do for the last week? So I said, did you watch all the videos? So I said, oh, no. He says, I only watched the videos that I thought were important. So I said, well, wait a minute. What part are you taking? He says, regulation. So I said, well, wait a minute. What didn't you watch? He says, oh, I didn't watch professional responsibilities and business law. All right. So he says, but I know them. Now, when anybody says, I know something, I immediately come out and give them a question to answer for me. All right. I asked him a question. He didn't know the answer. I said to him, between now and next Saturday, you better go and make sure you understand professional responsibilities in regulation and also business law. All right. Now, I told him to watch the cram course because I don't think there's enough time to watch the full course in 1 week. But my point is this. You, the candidate, don't determine what you think is important because every blueprint in the books, no matter what subject it is testable. And if you don't watch the video because you don't think it's important, it's like playing what we call Russian roulette. Okay? I don't know if any of you know what that is, but that's where you would put one bullet in the gun and you keep clicking, all right? And as long as the gun doesn't go off or that bullet chamber, all right, you can go on. But if they gave him a lot of stuff on professional responsibilities, and by the way, professional responsibilities in reg is multiple choice. Business law is multiple choice, but they're still important, all right? If you don't do well on those, you can do well on everything else, maybe end up with a 71, 72. Hey, don't try to outguess the AICPA, all right? Don't use a course that doesn't have the blueprints integrated, because if you are, you're paying yourself a disservice, and of course that course is paying you a disservice, okay? All right, now, next area is, Ron, any comments on any of that?
No, I think that's all good. And that leads me to the next question, Phil. In your opinion, what are some good strategies for you to do well on the task-based simulations, especially on FAR, Phil?
Well, the AICPA releases, we pay a royalty for the use of the multiple choice that are in our books. But when it comes to task-based simulations, they might have released to us a few of them, handful, okay? All right. Now, I asked Mike Decker, Vice President of Examinations, how do you prepare for these task-based simulations if you don't release a lot to us? So Mike said, if you go to the AICPA.org website, we've given you a couple to look at, Now, it's not to memorize every multiple choice, all right? And then you figure, well, if I memorize every multiple choice, then I have a real great chance, all right? And probably I'll do well on the task-based simulations. But also, I didn't say it exactly correctly. If I have a course that gives me 100 task-based simulations, they're probably all created by that course. And I asked people, did you have any of those on the exam? And they said, no. Why? They were created by that company, the course. So what you do is this. If you know the blueprints are the information that you're going to have to bring over to the computer at the Prometric Center. So look at that computer like a template, okay? And they're going to ask you different types of simulations. Now, we have examples of the different types. So you have to know the different types. But clearly, if you look at any of the blueprints, you'll see, if you missed one, that if you missed one of the task-based simulations, and I guess I'll give you an example here. I was told through the grapevine that they asked the simulation in financial accounting. They gave you an income statement, all right? And they wanted you to correct it and bring the items from the income statement that went into other comprehensive income, all right? Now, she said to me, this woman who's not using our books, all right, she said, well, I didn't see anything like that in my book. So I said, well, let me go look at the blueprints. I went to the blueprints, and there it said, make sure you know the components of other comprehensive income, all right? Now, what did she get on the exam? 72. If she had gotten that right, she wouldn't be telling me she got a 72. But you know what the other thing was, Ron, is, all right, she says, all right, you can't take the same part within a testing window twice, right? So she's going to start auditing. So I said, well, what are you going to do? She said, oh, I'm going to go back in that course that I paid that huge amount for. Hey, I paid for it already. I'm going to study the auditing. So I said to her, you know, if you didn't do well with the financial because you realized they didn't cover the blueprints, why are you using that course for the auditing, all right, just because you paid money for it? This is an investment taking this exam. And believe me, if you have to pay $500 for another book, another course, all right, you will make back that $500 many, many times over.
Quickly.
Yeah, don't be, the expression is don't be, dollar wise and pound foolish?
Foolish, yes, exactly.
Yeah, which means that, all right, think smart and
Yes.
just say, you know, I made the wrong decision. Okay, that was it. I bought the wrong course. All right. Hey, you did what you thought was right at that time. So don't continue using a material that's not going to work because nothing's going to change every time you use it again. All right. If anybody thinks that when they use it the second, third, fourth time, all right, they're going to open the book and miraculously it's going to be updated.
Yeah.
It's not going to happen. Okay. All right.
And
Now,
Phil, and let me give you another example on FAR. You know, sometimes FAR and the simulations, Phil, they will have a bunch of files you have to look at, right? You got to open up all of these files in order to decipher, you know, how to attack the problem. So how do you manage that, Phil, in your opinion? And how do you manage your time so you don't run out of time and you address at least some or all of the simulations on FAR, Phil?
well, there are, you know, on financial reg, there are 2 testlets of multiple choice. And I say you take 45 minutes on each one of those, a minute and a half per question.
Yep.
Now, that will leave you with, if you take the 4 hours, that's 240 minutes.
Yep.
If you subtract the 90 minutes, you have 150 minutes left, all right, for 8 task-based simulations. One of them is research. Now, the research is not going to count the same as the other ones. So I always tell people, try the research. It's very hard to practice it. If you don't come up with the answer, just move on. And don't spend more than 3 or 4 minutes on it. Now, that will leave 7 task-based simulations, all right? And roughly you have about 19 to 20 minutes on each one.
Exactly.
Now, what do you do with that 19 to 20 minutes? All right? You read the requirements, what they're asking for. What are they asking for? What do they want you to come up with? Then after you know the requirements, then you read the facts, all right? Because when you're reading the facts, you read the requirements, you have some idea what you're looking for in the facts, okay? Now remember, they're going to give you extraneous facts. You have to know which facts you need to use. Yep. And then you start answering the questions.
Yep.
You answer the responses. The machine is, the CPA exam is all machine graded.
Yes.
So when I took the exam, all right, I had a huge consolidation problem where I had to prepare a worksheet with the parent and the subs trial balance. I had to make the adjustments and eliminations on this worksheet, and then I had to do a consolidated income statement and balance sheet. Now, it was not machine graded back then. They took that because that went back to the AICPA, and they had people who used to grade the exam manually. Okay? Now you don't have that. In fact, all right, I was talking with Ron, and, you know, I don't know what's on the exam, but, you know, I try to take educated guesses, and I said, you know, if they give a consolidation problem, probably what they're going to do is this. They'll give you the parent and the subs trial balances. Then they'll have the columns adjustments and elimination entries.
Yes.
Now, they will ask you, all right, they'll have them, you know, like number 1, they'll show the debit and the credit. Number 2, debit, credit. They're not going to tell you which one it is. So they might say, all right, I don't know how would they put this? Elimination or adjustment number 1
is
what?
Yes.
All right?
Yeah.
Well, you have to know the different types of intercompany elimination adjustments. Yep. So if they say to you, what's the amount for the intercompany elimination and adjustment for profit on fixed assets sold from the parent to the sub that you have to eliminate on the worksheet? All right. you have to know which elimination entry that is. Now, the nice thing is this. I don't know if it's nice or not. All right? There's only certain adjustments and eliminations.
Yep.
For example, you always have to eliminate the stockholders' equity to sub against the investment account of the parent.
Correct.
Right?
Correct.
And, all right, remember, the investment account is an interest the parent has at the fair market value of the net assets of the sub.
Yes.
The stockholders' equity to sub is at book value.
Yes.
So the difference between the debits and the credits, when you close it out, it's going to be a debit to make that entry balance. It'll be excess of cost over book value of net assets. All right? Now, that elimination entry is made on the worksheet. Don't go to the books. All right? The next elimination entry is this. You have excess of cost over book value. Now, what do you do with that debit to excess of cost over book value? You're going to credit it in the next entry and that is the increase in the fair value of the assets of the subsidiary. Because when you consolidate, the parent is consolidating their book value of their assets with the fair market value of the sub's assets. All right? So the second elimination adjustment entry is the credit, that excess of cost over book value. And then you bring the assets of the sub up to fair market value or down to fair market value. All right? And after you do that, if the entry doesn't balance, the plug is to Goodwill.
Yes.
Are those book entries?
Yes.
The book entries?
Yes. Yes.
No. Do you make them on the books?
Well, no. These are consolidation entries, right?
Right.
In the consolidation columm, right?
Right.
You
don't go to the books of the subsidiary and write their assets up to fair market value.
Exactly.
The reason is this. The parent and the sub are just continuing to operate as separate entities.
Yes.
But in a consolidation, you assume that they are combining
into one company.
Into one company, which is the parent company.
Yep.
Okay? Now, from that on, okay, those entries are worksheet entries. And what are the other worksheet entries? Well, you have to eliminate all intercompany payables and receivables.
Very important.
If there's any inventory on the sub's books that came from the parent, parent sold that inventory to the sub at a profit.
Yep.
All right? Now, if you are one company, the parent, you can't make a profit on yourself. So what you have to do is figure out what the profit is in that inventory and credit that inventory for the profit, take it out.
In consolidation.
In consolidation, it's a worksheet, and debit cost of goods sold.
Correct.
Okay? And then you have, if the parent sold a fixed asset or the sub sold a fixed asset to the parent, all right, you have to restore the asset to what it would have been had the sale not occurred.
Correct.
Because remember, when the parent sold to the sub, the parent took that fixed asset off the books. They took the accumulated depreciation off the books. So now, remember, the parent cannot sell a fixed asset at a profit or loss to itself, the subsidiary. So you got to restore that fixed asset back to its original cost. Also, restore the accumulated depreciation that was taken off.
Yep.
And there should be a gain or loss on that transaction. Mm-hmm. All right? An intercompany gain or loss. Now, did I say that right? I think I
yes.
did.
Yep.
All right. Now, also, there could be intercompany bonds.
Yep.
Right? And if there's intercompany bonds, you have to figure out how much of those bonds are intercompany.
Yep.
Debit bonds payable for the intercompany bonds. The reciprocal account to that is investment in bonds.
Yes.
Okay?
Yep.
And then, all right, you determine, when you're actually eliminating the intercompany bonds, you're treating it as though it's an extinguishment of debt. Okay? So you debit the intercompany bonds, you credit the investment in the intercompany bonds, and then you could have a gain or loss. By the way, if those bonds are at a discount or premium, you have to eliminate the unamortized discount or premium.
Correct.
That has to do with those intercompany bonds payable.
Yep.
And then the plug will either be a gain or loss on retirement of bonds.
Yep.
And of course, that gain or loss does not go into extraordinary gains and losses.
No.
There's no more extraordinary gains and losses. When you do the consolidated income statement, what happens? All right. Those will go into the what? Consolidated income statement as other income. They're not extraordinary. Okay? I'm trying to think what else there would be. intercompany bonds, fixed assets. All right. But we have all of them in our book.
Yep.
Make sure you know them. Make sure you know what the accounts are, because they're not going to tell you that journal entry 1 on the work paper is for intercompany bonds. They're going to ask you, what's the amount of intercompany bonds that were eliminated? All right. Have you heard of any possibility that they could ask a problem like that, Ron?
You know, Phil, it's possible, right? Especially Goodwill stuff, right? Because today, think about it, right? A lot of technology firms are acquiring other technology firms. So certainly, right, Phil, Goodwill is a big item today on technology company balance sheets, right? Which
Right.
The ICPA is not stupid, okay? And they know that. And therefore, they figure a candidate, right, taking this type of an examination, academic examination, should be able to deal with that and understand the accounting for that in consolidations.
Now, long-term debt hasn't changed. Business combinations hasn't changed.
No.
And also, all right, I don't have time to do it now, but pensions. Make sure you know the journal entries for pensions.
Yes.
All right. I've gone over that. Unfortunately, I went over it on the one that was erased, but, go over that. And by the way, if you want to talk to me and then you want to talk to Ron, I can get you to him. But, all right, you can reach me whether you're a student or not. You want a little consultation, all right? I'm willing to help you. My number is area code 301-874-4900, and I'm extension 5. You can call me, all right? If you feel there's something you want to discuss that the course you have is not giving you, I am happy to talk to you because I want you to pass. Ron wants you to pass, believe it or not.
Absolutely.
Now, people have trouble. They say, God, what's the catch? What is the catch that we can call you? What's the catch that you tell people you're available on weekends too? There's no catch, all right? When I sell a course, I'm not going to say to you, don't study on weekends because I'm not available, all right? If you have a question, you should be able to get a hold of me, all right? Now, I have a calendar. If you call Sonny, you can get the link to that calendar and you can make an appointment. Get your name on there and I will call you. All right? I promise you, we're the only course that gives that top service. All right?
Yep.
And that's another thing. If you have a course that you're looking into, it tells you they give you service, what you should do is this. Say to them, all right, if I have a question, give me the number I would call. Don't buy the course yet, okay? So you dial the number, see who you get. You're going to probably get a customer rep person who is not a CPA, or you'll get someone else who works at that place who's not a CPA. You're not going to get the people who teach the course. I can guarantee that, all right? And try to get them. A lot of times they don't even return your phone calls, all right? Hey, I am an advocate for the students. That's the role I've taken on, all right? I'm certainly going to stay in this business to help the students because there are no advocates for you, the CPA candidates. All right? And you have very few people. Ron Premuroso, a guy who is so dedicated. He is dedicated to the students. All right? You contact him, he will get back to you. He keeps in touch with you to see, hey, good luck on the exams. Hey, this is a person you won't find in other courses. Okay? And that's why Ron is with me, and I never say he works for me. Ron,
the important thing, Phil, we want people to pass, Phil. The greatest satisfaction, Phil, we get is getting advice from a candidate that they passed a part of the exam. Or, even better, all 4 parts, Phil. That is our greatest joy in this job and role.
Yeah.
Well, Phil, we hope the candidates have enjoyed this, okay? And we hope, for those of you that got all the way through this, we hope that you have some good takeaways from this recorded session done by Phil and myself.
And I can honestly say that Ron and I enjoy doing this. We really do. I want to thank Ron for helping me with this. Thanks, Ron.
Pleasure, Phil.
Real asset. All right. Ladies and gentlemen, good luck with the exam. I've given you my number, where to get a hold of me. Please call me, and I'm here to help you. This is Phil Yaeger, and once again, I'm here with Ron Premuroso. All right. And have a real good day. Thank you.
Take care, everybody. Bye.
Thanks so much for listening to CPA Review and More. If you'd like more information, look us up on YaegerCPAReview.com. And as always, if you've enjoyed this show, please rate and review on iTunes or your preferred listening platform. Again, thank you so much for listening, and we look forward to you tuning in next time.